Welcome into episode 51 of Full Throttle, the Presidio Group's automotive industry podcast, and I'm your host, Jason Stein, Managing Director at Presidio.
If anybody's sitting around, whether it's the consumer or the dealer, waiting for the manufacturers to produce affordable vehicles, it's not going to happen because you can't make money at those points of the portfolio. And I would argue that even the companies that are still involved, which is usually the Asia-based manufacturers, whether it's Hyundai, Kia, or Toyota, or Honda, you know, they can sell, and they do sell vehicles in those price points, but it's not because they're profitable. It's an introduction to the brand. It's a way to find entry level and move up buyers that you believe you can keep in your portfolio for maybe the rest of their lives, for dozen or several more vehicle purchases, where the domestic manufacturers are saying you're just too far from our break even. We don't even want to get involved at those price points.
Kevin Tynan, our Director of Research, is constantly looking under the hood of dealership performance. And what he's seeing now is anything but ordinary. Kevin doesn't just observe the auto industry, he maps its undercurrents. In the wake of the post-COVID inventory reset, Kevin joins us to talk about the shift in margin drivers, the pressure points on pricing, and the surprising resilience of used cars and fixed ops. He also digs into something few people are talking about: the tech drain. After years of channeling R&D dollars into electric vehicles, automakers are now pulling back, and the average vehicle on the lot may soon reflect that. And what about affordability? Kevin says it's not coming back, not for the brands that abandoned entry-level segments, and certainly not for the domestic OEMs who've walked away from sub-$30,000 price points. It's a deep dive into revenue pools, margin trends, and why dealers need to rethink brand portfolio strategies in a market where profitability, not accessibility, is the name of the game. It's Full Throttle with Kevin Tynan, Director of Research at the Presidio Group.
Hi, this is Kevin Tynan, Director of Research at the Presidio Group, and this is Full Throttle.
Always great to have my friend Kevin back on the program. We spend a lot of time on stage together, and including just recently with the completed Drive-In Live series. Kevin, welcome into the program.
Great to see you again, Jason, even though it was only a couple of days ago.
Well, we've had our information out now. July 18th, we published our latest NCM Presidio Average Dealership Performance Benchmark. We also talked about where the industry is on our Drive-In Live series. There are undercurrents of activity that are below the headlines, if you will. And I know you've been looking at much of that, especially with public data coming out right now. What are you seeing out of the publics? What should we be looking at?
Yeah, I think that's the key word, is undercurrents. We've been talking about sort of segment rotation for some time. We went through a period where the new vehicle market was really carrying the day in terms of revenue growth, wider margins, right? Because we had this really tight supply and demand balance. And we knew, and we've talked about it a lot, going back several quarters, where at some point inventory would rebuild, which it has, and then you start to see some margin compression. You see prices weakening a little bit. And the question was, we knew that was coming, but how far does it go? Are the manufacturers overproducing to the point where inventory just gets frothy, and there goes all the pricing power and margins? And fortunately, that has not happened. Comfortable level, about 60 days, a little bit more than 60 days, 3 million units, with a reasonable amount of demand still there. So we haven't had this sort of runaway overproduction and discounting and incentives to move to clear the retail channel. But the fact of the matter is that there's little upside then to the new vehicle market. And then you knew that there would be some rotation, more focus on the pre-owned segment, more focus on parts and service. And it's exactly how we're seeing it play out right now. And as the publics are reporting it, it's confirming what we've started to see several quarters ago.
Parts and service primarily being the driver. You saw that out of the public numbers, right? What jumped out to you?
Yeah, that's that's a segment that is a small piece of revenue, but a big chunk of the gross. So That went up about 180 basis points to 44% of the segment gross profit for the franchise base of who has reported so far. That was closer to in the 42% range. So and that has to come from somewhere, right? It's a share of the total gross profit pool, and it is coming from the new vehicle segment. Surprisingly, and we saw this in the NCM data, the used market or the used segment has actually been pretty good for the dealer base and starting to rotate back in a little bit more. Prices are down a little bit, but there's a lot more volume there, and I would expect that that's going to be the next margin move higher would be in the used segment.
You've spent most of the summer on the road seeing state associations and talking to dealers. You have also shared a very compelling set of documents and data with those groups. And one of the things that you talk about is the new vehicle revenue pool in the United States. And looking at 2024 versus 2016, what were the surprising things that you've seen out of the revenue pool, and how's it playing out now?
Yeah, so I used 2016 because that was the peak volume year in the US. 17.5 million new vehicles were sold. The issue there is that now when you layer in average transaction price, which at the time was $35,000, you have a revenue pool, retail revenue pool that's a little bit more than 600 billion. Then when you jump ahead to 2024, it was only a 16 million unit market, so 1.5 million fewer vehicles sold, but average transaction price was $48,000. So what you get is a $150 billion larger revenue pool, even though 1.5 million fewer vehicles were sold. So when you're looking at just volume, and there's part of the industry that the total volume number does matter, because there's ancillary benefits of selling more vehicles, right? You're creating potentially lifetime customers and service customers and F&I customers. But at the end of the day, the revenue pool expands despite fewer units, maybe even because of fewer units, because you're getting firmer prices, less discounting, and less incentives from the factory coming back. Now, the issue I think we're kind of coming up against in 2025 and beyond is that there's several factors, again, undercurrents. One of them is truck versus car mix, where we're like coming up on 84% truck. That mix shift has really been the price driver, or the ATP, the average transaction price part of the revenue pool expanding really for the past 10, 15 years. Now, as we're at 84%, you kind of say, well, how much runway is left there? How much higher can we drive prices, or the industry drive prices, with a lower or stable volume number? And I think that's part of the problem that we're facing now. Not a lot of upside catalyst to volume and pricing at this point. Maybe not a lot of downside because inventory seems to be in control, but you wonder where the next catalyst comes from. What's the product or the technology that moves the revenue pool to its next higher level?
And for context, for those who don't remember, in 1992, that mix was 66% cars and 34% trucks. And now, as you just said, you're approaching 84% trucks and 16% cars. It's a wild swing. And when you even, another slide that you have shown is the percentage of light truck mix in the United States by manufacturer. It is alarming when you go back those 8 years on the comparison, isn't it?
Yeah. And the other thing about that too, Jason, is that 2013 was the last time we were 50-50 in the US truck versus car. And I make this point in my presentation everywhere I go, is that make no mistake about it. The earnings driver since that 50-50 split is that mix going to 84%. No doubt about it. Full stop. It's not more volume, right? Because it's been less volume. It's not electrification. It's not anything other than that. From day one, when automakers and dealers started trading a car for a truck, your revenue contribution, your margin contribution got wider, and it was accretive to earnings on the first day. And then it became like, well, that works well. Let's do more of that, right? And that's how we get to 84%. It can be 95%. It can be 100%. Look at, to your point, Ford, GM, and CDJR are in the upper 90%, like 97 plus. And in those cases, Ford has one car left. Mustang, just being iconic is all that's left. For General Motors, there's a couple Cadillacs and Corvette, and even for CDJR, kind of figuring out what to do with Charger after it went electric and maybe comes back. But cars are not the focus anymore, and the domestic manufacturers are out of the game completely in terms of cars.
Yeah, a little over 1 million units from GM, Ford, and Stellantis have been eliminated since 2016. You remember these names? Ford Fusion, Chevy Malibu, Chevy Cruze, Chevy Impala, Chrysler 200. That was going to save the company. Chevy Sonic, Ford Fiesta, Dodge Dart, Ford Taurus, Chevy Volt, and Buick Regal are all toast. Those were all around in 2016.
And what's amazing about that, right, is like 1.1 million units. And so it's not a question of, oh, we couldn't sell them or nobody wanted them. I mean, when you look at Chevrolet Cruze, that was almost 250 to 300,000 units a year. So that wasn't the problem. The problem was profitability. And the key point with that, with all those nameplates being discontinued, not because they couldn't sell, but because they were unprofitable. That is not a mistake. That is orchestrated. That is, we can't make money at that point of the portfolio because of cost structures, whether that's labor costs or materials costs. You just can't sell things. You can't manufacture and sell things in the U.S. at those low prices. The other thing in that list that you just read off, all of those vehicles, and keep in mind that was 1.1 million vehicles in 2016. Average transaction price was $35,000 in that year. All of those vehicles transacted below 30. So those were affordable vehicles for the time, right? Which is what everybody's clamoring for these days is, oh, there's no affordability. And I'm saying, yeah, because there's no profitability. So if anybody's sitting around, whether it's the consumer or the dealer, waiting for the manufacturers to produce affordable vehicles, it's not going to happen, because you can't make money at those points of the portfolio. And I would argue that even the companies that are still involved, which is usually the Asia-based manufacturers, whether it's Hyundai, Kia, or Toyota, or Honda, they can sell, and they do sell vehicles in those price points, but it's not because they're profitable. It's an introduction to the brand. It's a way to find entry level and move up buyers that you believe you can keep in your portfolio for maybe the rest of their lives, for dozen or several more vehicle purchases, where the domestic manufacturers are saying, you're just too far from our break even. We don't even want to get involved at those price points. So it's not a mistake. It's not bad planning. It's not bad marketing. It is completely an income statement decision that says we can't live in those segments. We can't do volume in those segments.
Yeah, it's a stark reality to where the world is today. You write in the upcoming quarterly report that we will release here shortly a research perspective. And one of the headlines in there caught my eye. Dealers waiting on affordability related, right? Should evaluate brand portfolio strategy. Explain that to me.
Right, because again, if let's say you're a dealership with a bunch of domestic rooftops, and you're waiting, you have buyers, and I get this a lot, and I'll speak at state association conventions, and somebody will, when I talk about affordability not coming back, somebody will raise their hand. They say, hey, look, my dealership is in a county where household income is $65,000. How is somebody supposed to afford a new vehicle that's $50,000? And I say, unfortunately, the automaker doesn't care, right? This is not about putting a car in every driveway anymore. And then what I say is, look, if you have that kind of customer base in that kind of geography, you need to go to one of those brands that do sell products in those segments and at those price points, because the ones that aren't in those segments and price points aren't coming back to them, right? So you can't expect a Jeep to come with a less expensive $25,000 vehicle. Now, if Hyundai, Kia, Toyota, Honda, Nissan are in those price points, that's where you're gonna attract those customers with those products. Waiting for Ford, Chevrolet, Chrysler, Dodge to do it, it's not going to happen. So if you have an area where that's the kind of customer you're dealing with, you kind of have to rethink your brand strategy, because you're not going to get it from the existing domestics.
One of the topics that's floating around here and a lot of conversation around EVs, but I want to attack it from a different perspective. All of the time, energy, investment that occurred over the course of the last decade, we're hearing is about to stop or adjust or switch back to either hybrids or internal combustion. There is a theory around the tech drop off that will occur in your mainstream vehicle that shows up because of all the time and energy put into a product that is now likely not going to sell as well, or programs will be outright killed. How about the tech drain on
Yeah.
the average vehicle?
Yeah, so certainly a pause in tech advancement, and if you want to
Hmm.
call electrification more advanced than internal combustion, I don't. That's neither here nor there. But the fact of the matter is, and what it feels a lot like, and certainly in a different way, but this is what happened heading into the bankruptcy period. And I'm not saying this is what caused the bankruptcy period or that we're on the verge of another one. But what you had somewhere around 2005, and I use 2005 as a metric because, that's when I was picking stocks back in those days. And it was
Hmm.
early 2005 where I said, I came out in the first quarter after GM reported earnings in the first quarter of 2005, and I said, this is a terrible earnings report. I said, this is ridiculous. These companies are bankrupt. Like, you look at the cost structure, the balance sheet, the legacy costs. I was like, this is unsustainable. And I'm thinking to myself in 2005, if I see this, they have to know this, right? And there's some fascinating books about it. Alan Mullally's book was incredible. He's like, they're either punking me or they don't get how dire this situation is in 2006, 2007. So what happens is, if you do realize that around that time, you stop investing, right? You're in cash preservation mode. You're in survival mode. So all that R&D and that CapEx, like, you're cutting it to the bone because you're just trying to survive. And then it wasn't really until the bankruptcy period and then the restructuring and the rationalization of cost and renegotiate the union contract and close factories and dealerships, right? So you go through this huge cost adjustment across the board, and then operating profit starts to come back in 2011, 2012. Now you start investing again. So if you look at the technology advancement from 2006 to 2012, there was nothing. Then all of a sudden, 2012 comes, and now we're like advanced driver assist systems and self-driving. And, I always think, you think about how we leapfrogged over, emergency brake warnings to actually the car stopping itself, or a little light in your side view mirror telling there was somebody next to the car actually correcting itself, right? That all happened very quickly because there was money to spend on that investment. And to your point, I think that's kind of what we're seeing right now, is that not that that investment in R&D got constrained because of the financial fear. It just went to the wrong place, right? It went into electrification, in that would be the next leg higher, right? We talk about the end of car versus truck mix. What's next? Oh, it's electrification. And here we are several years later realizing maybe that wasn't the right, or that isn't playing out the way we expected it to. and now you have several years and focus and capital that went to something that isn't paying, doesn't have the ROI that you had expected it would. And I don't mean, balance sheet ROI. I'm talking about just, adoption and consumer, just looking at that like this is the next thing and I'm okay and I'm comfortable with it. So yeah, 2, 3, model years where you're going to see a little bit in a pause in technology. Maybe internal combustion gets better and more efficient and more reliable or whatever we're looking for, but there's going to have to be a little bit of a catch up period.
It's almost like not a brain drain, but is a tech drain. Yeah. Kevin, it is always stimulating, enlightening, and informative when you join me. And so thanks for being on the program. You can look for the quarterly report coming out here shortly, and catch us on Drive In Live as well, once a quarter. And anywhere else that there's a microphone, there's probably Kevin and I are nearby. Thank you so much.
All right, buddy. Good seeing you.
Thank you. That's the 51st episode of Full Throttle. Special thanks to my guest, Kevin Tynan. Thank you for listening. For a library of these episodes with industry leaders, go to thepresidiogroup.com. You can also find a library of these shows on the Presidio Group's YouTube channel. I'm your host, Jason Stein. We'll talk to you again next time.